Good evening, everyone, and welcome. It's good to see everybody who's come to join us today to go through some of the highlights on the recent budget that was introduced by Finance Minister Chrystia Freeland. And there has been a lot of talk, as I'm sure you're aware, about some of the measures that have been introduced in this. And so we'll take the next few minutes and go through some of the highlights of the areas that will affect healthcare professionals. So, but just as we get started, just be aware of the limitations of the materials that are presented, and just so that we are clear and there's no misunderstanding about the limitations to the materials in this presentation. I want to go and show you where we're going to go in terms of our agenda this evening. And so you can see on screen, these are the 6 areas that we're going to touch on. At the end of our session this evening, we'll have some time for questions, so feel free to use the chat function to put your questions there, and I'll do my best to give you some answers as they come in. So we're going to talk about the first item, which is about the most controversial part of the budget that was introduced April 16th. We'll spend a little bit of time on lifetime capital gains exemption, registered retirement savings plans, and the home buyer plan, and you can see the other items. As we begin this session, we have a bit of a challenge. And the reason I say that is because typically when a budget is brought down by the government, along with the budget document, which you can see on screen here, it's this item right here, is draft legislation. And so it's that draft legislation that accountants and lawyers pore over to see just what the government has in mind. And even with draft legislation, then there's still regulations that come out of that, which talk about the practical implementation of any new tax laws. Well, what's different about this budget is that we don't have any draft legislation. And not only that, but the last 2 budgets, 2022 and 2023, there are still some pieces from those 2 budgets that have yet to become law. So now for 2024, we have a document that describes what the government's going to do, but we don't have any draft legislation. And so that's a problem for advisors because we don't know exactly what the measures that the government is describing in this particular document are going to look like. So we're all guessing. So I just want you to be aware of that when I talk about this major challenge down here, the rest of the proposed measures, these are the items up here which are included. But down here, the rest of the measures proposed in the budget, including the change in the capital gains inclusion rate to 2/3, lack draft legislation creating uncertainty, making it difficult for taxpayers to plan and execute necessary transactions before June 25th, 2024. So that's the environment, that's the situation we find ourselves in. So please understand that what I'm talking about this evening is our best guess. And that's wide open, and that's not an ideal situation to be in. I've got a couple of slides that is really just a couple of throwaway slides that talk about some of the major items. We'll go into more detail on some of these, and others we'll just skip past, but there's a new Canadian Entrepreneur Incentive Plan for up to $2 million that will phase in over the next 10 years. AMT will change. AMT is an acronym for Alternative Minimum Tax. There's some capital cost allowance measures that have been included. I just have something appearing on my screen here. So hopefully it's not appearing on yours. Then we have a carbon tax rebate, RRSP home buyer plan, Canada Child Benefit. Those are some of the items. Oh, and also CRA audit powers. So those are some of the items that you will see in the budget document if you were to read it. We're not going to deal with all of those tonight, but those are just some of the highlights. Disability support deductions, I put that in for physicians because as you see patients and so on, there's been some expansion on the list of deductions in disability supports. And the other items you can see on screen. So I won't dwell on that. I'll move straight to the content for tonight's presentation. And we'll start out with the capital gains inclusion rate. So just a word or two about what we're talking about when we talk about capital gains. Firstly, right now, maybe if I go to the next slide or two, I have a definition of this, but it'll appear in the next couple of slides. But when we talk about a capital gain, it's because you bought an investment and you paid $10 for the investment, and the investment grew in value, and it grew to $100. And so if you were to sell that investment, if you were to dispose of it, then you would have a $90 gain. That's $100 that you sold it for, minus the original cost of $10, means that you have a capital gain. And the taxable portion currently of that capital gain is 50% of that $90. So it would be $45. What the government is proposing is to change that percentage from 50% of the $90 to 66 2/3, so that you're counting more of that gain in your income and you're becoming taxed in it. The effective date for that would be June the 25th. It applies to individuals, but it also applies to trusts and corporations. So it covers the bases for pretty much all taxpayers. And what's different though is for trusts and corporation, there's no carve out, there's no exemption, because you'll see the last bullet on the slide talks about this change in the inclusion rate, the 50% going to 66 2/3. For individuals, that change only occurs when you have capital gains of more than $250,000. So right from the outset, if you're saying to yourself, does this apply to me? Ask yourself, do I have gains that will exceed more than $250,000? If not, then this change after June 25th won't have any impact on you as an individual. But if you have money inside of a corporation that's invested and those investments have increased in value, if you have real estate inside of a corporation and it's increased in value, there won't be an exemption for the corporations. There won't be the exemption that there are for individuals. All right. So understand that's the difference. That's what's causing so much uproar, is the inconsistency of this proposal, that in many instances, professions, for example, have been told you can operate through a professional corporation, so go ahead and incorporate. You do, you earn your income, you draw out what you need, you leave the rest inside the corporation and invest it, and it grows in value. That's your pension. That's the intention behind it. Well, in this case, they're saying, no, we're not going to give corporations the same carve out of $250,000 that we're giving to individuals. The $250,000 is on an annual basis. So each year, each individual, for example, would have $250,000. If there's a couple involved and those assets are jointly owned, then it would be $500,000 for that couple. So I'm just trying to broadly explain how these will be applied. Now, for 2024, because the phase-in date is June 25th, then anything before June 25th isn't subject to that increased rate. And anything after that is depending on the entity, whether it's a taxpayer as an individual or as a trust or a corporation. After that, then it will depend on whether it's an individual or a corporation. So for 2024, if investments are owned by an individual, they will have access to the $250,000 from January 1 until June 24th. June 25th, the measures kick in. So then at that point, presumably, and again, remember I'm saying we don't have draft legislation to know this is absolutely to be the case, but presumably then we would have the first $250,000 for individuals that would be exempt from the increase in the rate. So technically, we really have for individuals $500,000 for 2024, whereby individuals would not be subject to the higher rate where those two conditions exist. Firstly, in the first first 5.5 months of 2024. You dispose of properties and you enjoy the 50% inclusion rate. And then after that, if you're an individual, as long as the gains don't exceed the 250,000, so now we're at 750,000, or now we're at 500,000. That's 250 for the first 5.5 months, and then the 250 afterwards. An individual could have $500,000 of capital gains in 2024 and not feel the effects of this change. All right, so that's a little background. Let's put some numbers to this. Hopefully you can see this on screen. There's a lot of numbers, a lot of columns here, so I've broken it down further. So let's start by looking at an individual. The individual earns $1,000. So on the left column, you can see the way this is laid out. The individual, you or I, this is how we would earn $1,000. And in the right column, the same $1,000 is earned through a professional corporation. So what's that look like? And what we're doing here is a concept called integration. We're comparing the taxation of $1,000 by an individual versus the $1,000 earned through a corporation. And the concept of integration, which is, you may not be aware, if you have a professional corporation, we've always counted on integration to enable you to defer tax, and also that the overall amount of tax that you're paying will not exceed what you would pay as an individual. So in this case, you can see the individual earns $1,000. The amount of tax they pay on that is $267, and this is in Ontario. So they're left with $732.30. This is under the current setup. Now, the current setup for the individual who's incorporated has their income earned inside of a corporation, and this is not active income. This isn't income from the practice of medicine, for example. This is interest income, or I'm sorry, this is capital gains income that's earned. So firstly, we have $250 of corporate tax because it's earned inside of a corporation. So we're now down to $749.17 that corporation has after tax. I'm going to skip past this line for a moment, and I'm going to come right down to the bottom. And so right now, excuse me, $1,000 earned as a capital gain through a corporation will leave the corporation with $710. So there's a slight difference between the two. But on $1,000, the difference is quite small. 2.2% is the difference. So a couple of percentage. The advantage, of course, is currently there's a deferral. What do I mean by a deferral? Well, I'm talking about if you earn that capital gain personally, you would be left with $732. If you earned the same $1,000 inside of the corporation and paid the tax, the corporation would be left with $749 versus $732. The difference between these two numbers, $749 and $732, is 1.69%. Very little, but there's still an advantage to earning $1,000 of capital gains inside of a corporation. So that's existing for an individual compared to a professional corporation. We go on to looking at the impact that the changes will have on individuals after June 24th, 2024. So again, we're just saying, okay, to the individual, how much is this change going to impact? We've got $1,000, and so same column here, nothing's changed in this column. $732 is what's left after. For the first $250,000 to carve out the exemption from the new inclusion rate increase, nothing's changed, $732. But for capital gains that are in excess of $250,000 after June 24th, you can see the impact. They're left with $643.10. So the tax rate, effective tax rate, goes from 26.77% in Ontario, that's what we're dealing with here, to 35.69% after the change on amounts in excess of $250,000. So it's not a small amount. All right, let's go to the next slide. We're now looking at the effect that this change would have on $1,000 of capital gains earned inside a corporation. Same $1,000 here. This is under the existing regime. 50% is captured for tax purposes. And so $250 of tax is paid under the current 50% inclusion rate, leaving $749.17 inside the corporation. After June 24th, 2024, notice what happens. There is no $250,000 carve out, as you'll see here for the corporation, unlike there was for the individual. So immediately, income earned inside the corporation in the form of a capital gain will now be taxed at $665.50. 66, that's where we get our 66 2/3. Same thing over here. Anything over 250,000, the same thing happens. Now, summary for the corporation, the effective tax rate currently, as we said, was 28.97. Corporately, 38.63% in Ontario, so quite a jump, right? The tax cost is up by 11.86%. And now, and this is significant because you remember I talked in the previous slide and I said, over here, at least you had a slight deferral of 1.69%. So it wasn't huge, but you paid $749 or you received $749 after tax of $250. So you still had a little bit more left in your corporation than you would if you earned that personally. But now that's changed. Now there's actually a tax cost, or the deferral is lost, and you end up paying more out of pocket at the corporate level. Remember here, this is the existing regime, $749, and for individuals it was a slightly different amount. Now it's $665 compared to whether it's earned by an individual. So there's an actual cost to this in the deferral. So that's the consequence. Now, before you start stressing about this, just remember what I've said. From January 1 until June 24th, there's no impact on either corporation or individuals. 50% inclusion rate, we're assuming will continue to prevail for that period of time. So if you're going to do any disposition because you're concerned that the tax cost is too high to incur, then you'll want to do that between now and June 24th. But remember, we're talking about for the first quarter or the first almost half of the year, you've got access to an unlimited amount of capital gains. And if you've got investments after, we're only talking about an impact to individuals where the capital gain, in addition to the first half of the year at 50%, then after that, there's another $250,000 whereby individuals are carved out. So just think to yourself, do I have any assets where we have that kind of gain? What are we talking about? Investments, real estate, collections, whereby there's gains in those collections, works of art. Those are the types of things, shares of your corporation. All of those are the types of assets you want to be thinking about and saying, all right, this legislation comes in, but am I affected by it because look at the amounts we're talking about. So I just want to say that up front so that you don't spend the rest of the presentation doing calculations in your head, thinking to yourself, how am I going to get out of this? Because as an individual, you may not be affected by this. All right. So just as a summary, after June 24th, the tax burden for individuals earning capital gains over $250,000 through a CCPC will rise by about 8.5% to nearly 10% based on the province of residence. And any minor tax deferral benefits that exist at present will be removed, resulting in the prepayment of tax in a corporation in comparison to whether it's earned individually. All right. Now, the next slide talks about other consequences. What else do we need to be thinking about that could be affected? And by the way, when we talk about the impacts of this inclusion rate, I've also made a note on the right side of the slide here, is that right now the provinces, which also have their own tax acts, have not yet changed. Quebec has indicated that it's going to follow the federal government, but we don't know if Ontario will. So this change right now has put our tax system federally and provincially out of sync, where the federal government is charging a different level of tax because of the inclusion rate than provinces. So depending on where you are, there's going to be that consideration as well. Estates, if you're dealing with an estate which has capital gains in it, that could be affected. Then if you're an individual has employee stock options, again, it's likely that we'll see the deduction for stock options, which currently is 50%, reduced to a third, effectively resulting in taxation of 66 2/3 of the value of stock option benefits. So again, that's kicking in, we assume, after June 24th, 2024. If somebody's leaving Canada and they're going somewhere else after June 24th, when they are deemed to have disposed of certain assets when they leave the country, which is automatic, you leave Canada, there's deeming provisions in the Income Tax Act that certain other assets are considered to have been sold for tax purposes. So again, you want to take into consideration that if that were to occur afterwards, the amount of any gains that you have on those properties would be taxed at a higher rate after June 24th than they would be beforehand. So you might want to consider departing before this date, if at all possible, so that those deeming provisions won't have adverse consequences. So those are some things just to be aware of. So what are some strategies to mitigate the impact of the capital gains inclusion rate? Well, firstly, start and make a list of all your assets. Look at your investment accounts. Consider the real estate that you own, the home in the city, the cottage that you have, the rental properties that you have. And also remember, one of the consequences I didn't put on this slide was if you have a home and you change its use, it changes from your principal residence to a rental property, you have a change of use. And one of the deeming provisions in the Income Tax Act says that that change of use is a taxable event. Now, if it was your principal residence going to a rental property, then I'm not concerned about the impact because it's sheltered by the principal residence exemption. But if it's going the other way and you've got a rental property that you decide you're going to make your house, well, you've got a deemed disposition on that change of use. If that happens after June 2024 or June 24th, 2024, you are going to have potentially a gain on that property just because you're changing its use from 50% to 66 2/3%. If you've got a cottage that you rent out on Airbnb and you decide you're going to change its use from it being a cottage to your own personal cottage, or going the other way even, and even if it's your own cottage, but you decide not to elect on that property to use the principal residence exemption, you're going to face a higher tax bill as a result of that increase in the inclusion rate. So those are some other things to consider here. So identify all the assets that have an accrued gain. And what I'm talking about here is when I say accrued gain, it means that they've gone up in value over what you've paid. But you're not taxed on that increase. You're only taxed on the increase when it's realized, when you sell it, when it's disposed of. So before you do anything, first identify all the assets and the gains associated with each of those. If you own investments or assets that aren't in a registered account and have increased in value but haven't been sold yet, then consider some of the following options. One, you can sell them. You could sell your investments before June 25th, 2024 to trigger a capital gain at 50%. So take advantage of the current inclusion rate. You could transfer that property to your spouse, to a company or a partnership you own, or to a trust. So that's another option that could trigger a disposition, and the disposition would be taxed as a capital gain where there's a gain, would be taxed at the current 50% inclusion rate. So that's another option. And by the way, for those watching that have larger gains than what we're looking at typically for an individual, when I talk about that, I'm talking about $250,000 of capital gain. You also have to remember there's this other provision called the alternative minimum tax. This is an alternate tax calculation that is imposed on certain types of income, including capital gains, which could be triggered. So alternative minimum tax, as I say, is a second calculation. And basically the government says, if we can't get you on the first calculation, you've got certain types of income, we'll get you on the second type of, or the second tax calculation called alternative minimum tax. It means that we expect you to pay a minimum tax, a minimum income tax, if you fall into this calculation. You have to be careful of that, because even though you're triggering to take advantage of this inclusion rate, this current inclusion rate, you might inadvertently walk into alternative minimum tax. The good thing about AMT is it's a refundable tax. So in the following 5 years, you can recover that AMT, but it will have an impact on your cash flow, because when you file your tax return next April or next June 15th, depending, but you'll have to make sure you've made your payment by April 30th. AMT could affect the balance that you owe. So just be aware of that. All right, so we talked about the strategies for individuals. You could sell it on the market, get rid of it, make sure the close date or the transaction date is no later than June 24th. And so you would enjoy that current rate. And then for corporations, same advice, identify all the assets that have an accrued gain. And if your corporation owns assets that have increased in value but haven't yet been sold, these are the steps to consider. Corporation can sell in the same way as individuals to somebody outside prior to June 2024 to trigger a capital gain and take advantage of the inclusion rate. On each of these points, I've said get guidance. I'm not trying to be flippant about this. You can see from what I've told you just how tricky this is. So I would not just go out and trigger gains without first getting somebody to look over your shoulder who knows what they're doing to make sure there isn't any unintended consequences. And then also, with respect to capital gains, I have a client, a couple of clients who have sold real estate or sold their practice in the last year or so. But the arrangement in the transaction is that they don't get all their money up front. And so what ends up happening is they get a certain amount of money for the sale of real estate or the sale of their practice for their shares, but half the money in one instance with real estate was received and the other half was spread out over the next couple of years. The Income Tax Act has a provision called a capital gains reserve. That means that if you haven't received the money, you can claim a capital gains reserve that will take effect to a maximum of 5 years, effectively 20% of the unpaid amount over the remaining 5 years. So you don't have to borrow the money, for example, to pay your tax and pay the tax on the full amount when you've only got 50% of the transaction. So, for example, the person that sold the property for $10 million and only got $5 million up front shouldn't have to pay tax on the capital gain on the $10 million sale. They should only pay tax on the portion that they've received cash for. And so the Income Tax Act makes a provision for that called the capital gains reserve. So that's one instance, or the person who sold their shares for a dental practice or a practice where there's a gain, but they haven't yet received all the money because it's triggered over the next couple of years, can claim that reserve. But here's the problem now. When you have a situation like that, and this is what we don't know for certain, this is part of why we want draft legislation to make sure that we're guiding clients correctly, but we don't have it. And so we have a situation where we have to say to clients, okay, well, if you're claiming a capital gains reserve on the remaining $5 million that is yet to be paid, even though you sold that property, that piece of real estate in 2022, when the inclusion rate was 50% at that time, because now you're only just receiving the other $5 million in 2024, guess what? We think that's going to be treated as a capital gain, and it's going to be a capital gain in 2024. And if that comes into effect after June 24th, 2024, you're going to have an inclusion rate of 66 2/3 instead of the 50% that was in effect when you sold the property. So our advice to clients right now is, if you want to be certain, even though we don't know what the legislation is going to contain, maybe you don't want to claim that principal or claim that capital gains reserve. Maybe you just want to pay the tax and take a chance because you're about to get it, and in the next year or so. So that's what we're talking about, whether that's, and that's at the corporate rate or corporate situation, or also for individuals. Just be aware of that. If your corporation owns assets that have increased in value but haven't been sold, here's some other strategies. Transfer within a business. You can transfer assets between corporations to a subsidiary or another holding company, for example, and that could trigger a capital gain at the current inclusion rate. Or to a partnership, you could sell assets to a partnership. If you're a healthcare professional that's built up a couple of $1 million inside of your professional corporation and there's large gains on that, you could consider an in-kind dividend, so that rather than selling the investments, you could just transfer the value of the investments out in the form of a dividend, which would trigger a capital gain inside the corporation on that. The corporation would pay tax on that, and you would continue to own those investments outside the corporation. Or you could simply sell them inside the corporation and buy them back, and you would have a bumped up cost because now you would have sold them at the current fair market value, recognized the gain, and bought them back again, and you would have a higher cost base, so that if they continue to appreciate in value in the future, then you would only be taxed on the gain that increases from that point in time in the future. Only that increase after the current disposition would be taxed at 66 2/3. So, but you could just move your investments out of the corporation, take a dividend, and pay the tax inside the corporation as well as outside the corporation. That's actually not a bad strategy in this situation. So I have a couple of clients like that where we're considering that strategy. You could just wind up the corporation and distribute the assets and do that before June 24th, 2024, and that would also have the same effect. All right, that's the biggest part of this presentation. That's the one that everybody's interested in. So now we're going to go on to other aspects. And the next one doesn't necessarily affect physicians so much, because we don't see physicians typically selling their practices. There are still practices that are sold, but they're usually specialty clinics and things like that. That's what I see most frequently, but normally just regular practices don't sell. So we're not really running into a situation where we want to take advantage of what's known as the lifetime capital gains exemption. But let me explain what this provision is. For those that maybe you have a spouse or a partner that has a business, and that business is not a professional corporation, but that it's, or it could be a dentist, it could be a vet. Those are the types of practices that do sell and fetch considerable amounts of money for them. And so in situations like that, or just a regular business, a corporation, in situations like that, there's a provision in the Act called the Lifetime Capital Gains Exemption. And currently, the Lifetime Capital Gains Exemption, that's the acronym there, is $1,016,836. So the first $1 million, let's call it, that somebody realizes is the amount of the gain that person would have, times that by 50%. So the first $508,000 of taxable capital gain is shielded from tax. And the value of that is considerable. The income tax on that's $271,000. So the fact that you're sheltering that amount is saving you almost $272,000. Now, under the proposed budget, the lifetime capital gain exemption is going up. It's going up to $1.25 million. But for people that have a gain of 1.25 or above, but in this case, the capital gain of 1.25 million is subject to the higher inclusion rate, so now 66 2/3. So now in this case, then the exemption from that is 833,000, and the amount of tax that somebody would pay on that is $446,000. Now, let me slip to the next slide. Here's a summary of what this looks like. Under the existing lifetime capital gain exemption, a person can shelter $1,016,000, and they will pay tax of $271,000, so they'll have $744,000 in their pocket after tax is considered. That's because of the lifetime capital gain exemption. When the new provisions kick in, it will now be 1.25 million that's sheltered. The person will be left with 803,000. Now, with proper planning, you can multiply these lifetime capital gain exemptions. So a spouse can own shares, kids could own shares, so that we can multiply the lifetime capital gains exemption among family members. So a family of 4 would have $5 million under the new regime that a business could be sold and it could be sheltered from tax. You'll see the difference that is favorable. It appears to be favorable. But just to point out one detail, that although this looks like a good scenario, and it is, they're further ahead, what's hidden in these numbers is the fact that if a person doesn't have a lifetime capital gain exemption to rely on, and they sell their practice for these kinds of numbers, their tax cost on the same transaction has just gone up $174,000. That's the impact that selling after June 24th, 2024 will have with the increased inclusion rate. So that's the lifetime capital gain exemption. I always caution people who want to multiply the capital gain exemption, especially with minor children, be careful, because once those shares of your minor child are sold, that is not your money. It's your child's money. And do you want a minor who at age 18 will now have a couple of $1 million that's theirs? Do you want them having that money? So that's just an aside, but for those that are doing some calculations and saying, wow, I've got a business that's worth $5 million, I could get out of the tax from that. It isn't always just about the tax. So just be aware of that. All right, now we've gone over the capital gains inclusion rate and kind of beat that to death. We've looked at the lifetime capital gains exemption. If you didn't know that was there, it's there. Everybody has it, and it's going up. And so that can be a good thing. Now let's talk about registered retirement savings plans and the home buyer plan and an update to that. Currently, the RRSP rules around loans from RSPs, you can take it out for two purposes, home buyer plan and lifelong learning plan, but you're borrowing money from your RSP. When that occurs, it's currently $35,000 and it's repaid over 15 years. The proposed changes under the new budget raise that $35,000 to $60,000, applicable to all eligible home buyers, including those buying for a disabled individual. And they've also extended the start time for the repayment by an additional 3 years. So it's now effectively the 5th year that after somebody's borrowed money that they have to start to repay that loan that they've taken from their RSP. So those are the changes that are made with respect to the home buyer plan for RSPs. All right, moving on to crypto. Now, crypto's controversial. It goes up, it goes down. Some people believe strongly in crypto. What was mentioned in the budget about cryptocurrency, crypto assets? Well, the amount of reporting is now about to increase. It's going to increase from 2026. That's the implementation date. But just so that you're aware about how assets that are held in different forms, in different places, there has been a reporting standard called the Common Reporting Standard. It's a global standard that governments all subscribe to, which basically say, if you give us information on our citizens elsewhere, we'll give you information on your citizens and their assets elsewhere. It's an exchange of tax information, making it more difficult to launder money, to hide assets. And so that common reporting standard now is participated in by countries throughout the world. But that standard up until now has not included crypto assets. And so the budget is now saying we are now going to add to the list of assets where information is required, crypto assets like stablecoins, NFTs, which aren't currently covered under CRS. And there's going to be annual reporting requirements for Canadian crypto asset service providers, exchanges, brokers, dealers. They're all going to have to report on the transactions, much in the same way as investment houses have to, on the transactions that occur with their clients' interest, dividends, return of capital, capital gains, so proceeds of disposition, all of that information that gets sent out on T3 slips and T5 slips and T4A slips. Now, crypto transactions will also form part of that reporting obligation. The reporting includes exchanges between crypto assets and fiat currencies on transfers over $50,000. And as I said, that is going to take effect in 2026, starting in 2026. So that's something to be aware of. They are going to ask for information on financial accounts and account holders. So you are going to have to be willing to provide that information, or these exchanges and all the parties that report on these types of things and keep them are going now to be obliged to keep track of this information and supply it to the government. So be aware of that if you're a cryptocurrency or crypto asset investor. All right. The next point I wanted to draw to your attention is for physicians who might have patients that would be affected by this, and it's disability supports deduction. The expenses that are claimed currently are now being expanded as of the budget 2024 to include the items that you'll see listed here. So all of these items will now be added to the list of expenses which will qualify for the disability support deduction. Expanded expenses, service animals with an effective date of 2024 and beyond. So just be aware of that. If you have patients coming who are looking for verification that they have purchased or have had these particular expenses, then you'll be aware that this list is expanded. All right, the last has to do with CRA audit powers and penalties. And this is alarming. We're moving more and more towards the same type of system that the US has. The US has astronomical fines and penalties. If you fail to file a particular form, the penalty can be 50 grand US. And so in the last year or so, we've started to see hefty penalties. Penalties like we've not been used to before. The first came out with the underused housing tax. Remember, that was the first year when the government came out in 2022 and said, if you have a house and it fits this definition, you have to tell us about it. Even if there's no housing tax imposed, you must tell us about it. And if you don't tell us about it, there's a $5,000 penalty for failure to file. And if the property or if that housing unit is owned by a corporation, it's a $10,000 penalty. So these are not $150 or $200 penalties like we've been used to. These are penalties with some real teeth. So now what we're starting to see is, and then of course we saw the trust reporting rules for T3 trusts and bear trusts this past year, and the threat for stiff penalties for failure to report those trust relationships so that the government would know that you're on your mother's bank account or that you're you're holding a piece of property for your child because they needed your assistance to finance the purchase of a condo, and so now your name's on title, although you don't have an economic interest in it. You have a legal interest in it, so that would need to be reported. Those types of things, and failure to report again was a hefty fine. Well, now you can see the CRA can now issue or will be able to issue a new notice for non-compliance. That's when we're in an audit situation and they've asked for information and you don't want to give it to them, or maybe your lawyer has told you you don't have to give it to them because of privilege. They can now impose a penalty of $50 a day up to a maximum of $25,000, and that is reviewable by the CRA or a judge. And so a judge can impose that penalty. Even though you might be getting advice from your lawyer that you don't have to turn it over because it's privileged, it's just one more fight you find yourself into to have that penalty reversed. That's not a small amount of money. So notice of non-compliance. Compliance orders, a penalty of 10% of the tax payable will be imposed if the CRA obtains a compliance order against a taxpayer, creating an incentive to comply. So if you've got a real estate transaction and it has a $250,000 tax bill with it, or tax liability attached to it, 10% penalty can be added to that. So again, not a small amount of penalty, and certainly creates incentive to comply to avoid those. Not only that, questioning under oath. The CRA can now require information or documents to be provided under oath or affirmation. Never had that before. And then stopping the reassessment clock. There's a period of time normally when the CRA must complete their reassessment period. Now, for that period of time, you can see the reassessment period will be extended when a taxpayer seeks a judicial review of the CRA. So right now, if you're in an audit situation and the time is running out, whereby CRA has to issue their reassessment notice by a certain date, that there is a document that's given to you basically saying, okay, we're gonna waive that reassessment period. But in this case, CRA is basically saying, no, we're going to extend that reassessment period when a taxpayer trying to exercise their rights seeks a judicial review of the CRA's requirement, or when a notice of non-compliance is outstanding. So another measure to clamp down on taxpayers. And then these types of powers will also be applicable to other pieces of legislation, like the Excise Tax Act for GST and HST, and the underused housing tax. So these powers will extend not just to income tax returns, they'll extend to GST returns and underused housing tax returns, and presumably other things like T1135 forms, presumably. We don't know because we don't have legislation to see the extent of this, but that is what they have talked about. All right, so that covers off the items that I think are of interest to healthcare professionals. We have some time left. Mustafa, are you there? Do we have questions?
Yep, we have a question here. Are investments within a life insurance policy considered a capital gain?
No, they would not be considered a capital gain. They fall outside of that. So I don't have a lot of details on that, but in other words, I don't have a lot of details from the person asking the question. So generally speaking, no, they would not be subject to capital gains inside of a life insurance contract. Anything else?
If anybody else has any question, please use the Q&A section to ask it and we can get that answered. We have one that came in here. The new GAAR rules make surplus stripping no longer advisable / possible.
Yeah. We talked in the last slide about the new measures that are being imposed, and I would say over the last 15, probably 15 years, there's been what's known as GAR. GAAR was put in the question, stands for General Anti-Avoidance Rules. And it's a level of scrutiny, it's a set of rules that the government can impose and look at it and say, are you using the provisions of the Income Tax Act to your advantage? Now, it used to be that taxpayers could arrange their affairs to the best of to take advantage of and arrange their affairs in the most advantageous way possible. But then the government said, hold on a second, you're using some of the provisions in the Act to get at things that Parliament never intended you to take advantage of. And what is a common example of that is surplus stripping, where there's a series of transactions that are executed in order to trigger a gain so that somebody can get money out of a corporation, for example. Maybe they got a couple of $1 million sitting inside of a corporation, and if they were to pull it out as a dividend, they would pay tax, say in Ontario, at 47.74%. But if they execute these series of transactions, then they will not have to pay tax at the rate of a dividend, but at a capital gain rate, and so or closer to a capital gain rate. And so GAR came into play where CRA was saying, yeah, you're using the Act for your own advantage here, and there's no economic substance to what you're doing. You're not doing that because you want to break your company apart and take advantage of a new opportunity somewhere else. You're just booking some entries to trigger transactions that'll appear on a tax return. We don't like that. And so we're going to impose penalties where the income tax is abused. We're going to have GAR penalties. Last year, July 23rd, I think, they introduced new legislation that upped the ante on GAR so that now there's notifiable transactions and there's reportable transactions. So the government now has a registry, a list of transactions that taxpayers can go and look at to see if the transaction they're anticipating, like a surplus strip, falls into one of those offensive transactions that CRA considers to be abusive. And so now, if an accountant, a lawyer, an employee of a company, or the shareholders of the company enter into these types of transactions, they have a very short period of time, 45 days, to file a prescribed form that the government has created that says, that type of transaction, you have to tell us certain details about it to us within a period of time so that we can look at it. And they notified, they made the public aware that as of December 31st, 2024, after that, surplus strip types of transactions would fall into that category. Now, there's been some talk saying, well, we can still get around it and so on, but that would be an example of where certain types of transactions, like surplus stripping, now fall into that category. And people that enter into those do it at their own peril, because if they have GAR penalties imposed, those are significant penalties. Now, there was some talk about some types of transactions that were entered into actually being considered criminal. The government's backed that back, and they've taken away criminal penalties from that. But that's how serious they were at one point considering it. So GAR is not something you want to take flippantly. And when we talked about the strategies earlier in the earlier slides about crystallizing those gains, selling them to other entities to crystallize, the government, by giving taxpayers a period of time from April 16th to June the 24th, is basically saying to taxpayers, okay, we're going to give you time to arrange your affairs such that you can take advantage of the lower rate if you wish to. But if you take that too far, we're going to look to consider whether GAR is applicable. So it's generally held in the tax community the types of transactions we were looking at this evening. Selling on the open market, nothing you can do about that. That's just a regular transaction. Selling among family members or to companies and things like that are considered to be non-offensive types of transactions. But the government has continuously through that document said, but be aware that you don't cross the line and get into GAR territory, because we will consider that. So I don't know if that helps you, but that's a little background in terms of how the government looks at how aggressive taxpayers can try to take advantage of certain provisions in the act for their advantage. Any other questions?
Yes. How does one know if they've used up the CJLE of 1.06 million?
Mm, that's so the question is, how do I know if I've used up my lifetime capital gains exemption? Normally, not many people have that type of transaction, but if I'm looking at a situation where somebody's triggered the sale, they've sold their practice or something like that, one of the things that we would do is we would go onto the CRA website, we'd look at their history to see is there any capital transactions whereby they have claimed the capital gains exemption beforehand. Because if they have, then you need to take into account other transactions that have already eaten into that balance. So you've got 1,016,000 currently, but if you'd used up 500,000 of that in previous transaction or transactions, of course you only have 516,000 left. So you would go back and you would look at the history of other capital gains exemptions that have been claimed, so as not to overclaim it.
Um, in
Anything else?
general, in general, at what income would a corporation no longer be beneficial with the changes in
Mm.
tax rate?
You know, this is a question I'm getting asked a lot. Should I keep my professional corporation? Does it make it worthwhile? Should I incorporate because of these changes? I was talking to somebody today, and they said to me, the government's tinkering so much with small business corporations. So, do I really want to go there? And I said, actually, they're not tinkering that much. That's kind of hearsay within the medical community that the government's tinkering. They're not tinkering a lot. They've tinkered with small business deductions. They've tightened that up, but it's not targeted at them. And you still have a significant deferral of income tax inside of a corporation. So there is not one amount of money. Everybody would like to say, oh, is there a perfect time for me to incorporate, for example, or is there a certain amount of income I need, or when does it no longer make sense not to have a corporation? I have a professional corporation. My accounting practice is a professional corporation. I will never not have a professional corporation. These rule changes, they don't take away some of the major advantages. So as I said to this person today who was trying to figure out should they be using their RRSP more now with the inclusion rate, and I said, well, what's your investment strategy? Like, are you a day trader? Are you somebody that has a lot of transactions going on inside of a corporation, so you've got gains that are being recognized over and over again? Or are you a buy and hold investor, whereby you've got investments, maybe you've bought mutual funds or ETFs, and you just keep buying them. You don't sell them, you just keep buying them. Well, a corporation is a great vehicle for that. Just like if you held them in a registered or a non-registered account or a registered account. So it depends on what you're trying to accomplish. But there are so many extra options, so many levers that can be pulled with a corporation that you can't do as a sole proprietor. And so I can't begin to enumerate them, but just one that comes to mind is your ability to time when you report income. You can earn 500,000 in a professional corporation and just take out what you need to live on and leave the rest in there. And you can invest it and let it grow, and you won't feel the impact of this any more than you're going to feel the impact of tax when the time comes for you to start taking money out of your RSP. So I would caution people not to overreact to this. This is not great news. And there is an implicit unfairness as it's been presented by the government at this point to not have a carve out for corporations of 250,000 like is the case with individuals. But I suspect that this is just my own thoughts, but I suspect that perhaps the reason that the government has not tabled legislation is there might still be some wiggle room in terms of how the draft legislation gets presented. And maybe they will come to their senses on this and adjust that. But as far as incorporations, yeah, there's still great advantages with a corporation. I see our time is quickly coming, so I'm hoping it's not going to shut down and it's going to continue on. I guess we'll see. You still there, Mustafa?
Yep, we're good. We just have a couple more questions.
All right, let's keep going.
So is an IPP now a more viable slash attractive option if this budget
Hmm.
passes with the new 66% inclusion rate?
Hmm. You know what? That question is so fact specific. Um, I I would have it would depend on a file by file situation. I'm sure there's a lot of financial and insurance advisors now playing on people's concern about this, that they would posit that. I would have to look case by case on that. And IPPs come and go in popularity over time. So I'm gonna respectfully decline an answer on that because it does depend so much on how long's the corporation been around, what's the salaries that the person has taken out over time to determine whether or not it makes sense. What's the age of the person who's the shareholder? All of those are factors that you'd want to look at when considering an IPP. So no simple answer to that question.
Okay, so for a young physician just starting their practice, would you still advise creating a professional corporation, or has this change made it no longer advantageous?
You know who I'm worried about? Who I'm worried about with this budget is not the young physicians. I'm worried about the ones who are mid-career and late career who have got to make some decisions with the wealth they've accumulated. But the young physicians are the ones that I'm saying this gives you options. I'll give you an example. You can take out dividends or salary out of the corporation. We talked about taking money out only what you need to take out. You can take out money as a shareholder loan. You can take money out as a dividend. You can take money out as salary. But as an example, if somebody takes out money out of the corporation as a salary, their corporation will have to match the CPP premiums that the individual has taken on their salary. Right now, that's about $8,000 a year. Well, you can go, we work, a little bit of background on CPP. We work from the system is structured to say we work from age 18 and we retire at age 65, 47 years. Well, you can go for 38 to 39 years paying into CPP and still get a full benefit. That means there's 7 to 8 years where you don't contribute to CPP. Maybe you take out dividends instead of taking out salary. So for somebody considering whether a corporation makes sense or not, especially starting out, I'm telling you it makes sense. Because if I can save 6 or 7 years of CPP contributions, both personally and at the corporate level, I've just saved almost $50,000 just in CPP premiums. And that's one item. So combine that with the differences in tax rates depending on the types of income you're taking out. Don't forget, you also are still able to take out money through accounts like CDA accounts, capital dividend accounts, when there are gains. So you're just not taking out as much in capital gains. But I would be misleading you if I said that capital gains left inside of a corporation are okay. They're not now. We saw those numbers tonight. But I would not be moving away from setting up a professional corporation. There are too many options available for somebody, and it's still a simple structure.
Yep, that's it for questions today.
That's it. Well, everyone, thank you for your time this evening. I hope you found this helpful. If you have any further questions, please feel free to email me. I'd be happy to answer those questions. And once again, thank you for your time and interest. And as more topics, more information comes to light on this, we'll resume our conversation on this via GoToWebinar. All right. Enjoy the rest of your day. Take care now.